This week, headlines screamed war escalation and recession risk. The market? It digested the noise and still rotated under the surface. Welcome to Capital Sound's Weekly Wrap. I'm Mandy Prince, here with Milan Patel to break down why the tape didn't panic and what mattered more than the headlines. Let's set the table with a market snapshot, then we'll go deep on the big drivers. Milan, in plain English, how did the week feel?
The week felt like a tug of war between headline risk and underlying positioning. Indices were mixed, not dramatic, but leadership shifted. Some of the defensive parts did fine, but there were also quiet pockets of resilience in cyclicals. It wasn't a clean risk-off week.
That's interesting. People watching the news might assume it was a straight-down fear-driven sell-off.
It wasn't. The market seemed to acknowledge risk while also testing whether the real economy is still intact. That's an important nuance. A full-on panic would have been broad, and it just wasn't.
Okay, in a sentence, what's the key theme in the snapshot?
Rotation, not capitulation. Energy strength tied to the war narrative, but also some resilience in areas that imply investors aren't pricing a full stop.
Let's slow this down. If someone only saw the headlines, they'd think everything broke. But you're saying breadth and leadership told a more balanced story.
Right. Breadth wasn't great, but it wasn't an avalanche. It was selective. If you look at what typically collapses in a true fear spike, it didn't all collapse. That's a different kind of week.
Oh, good. That frames it. Now let's go deeper on story one. Deep dive number one, the war narrative and the energy shock. The takeaway first, this was a headline risk week, but the real market question is about duration, not just severity. Milan, do you agree?
I do. The market's first reaction is always about shock. What's the immediate impact? The deeper question is, how long does the disruption last and how sticky does it become in prices and behavior? The current story is that energy prices have surged, and that can ripple across margins, consumer spending, and inflation expectations.
Let's anchor it with the one number we actually have. Oil is up over 90% this year. That's huge. Yet equity markets didn't freeze.
Exactly. A move like that should lead to a reflexive fear response, but what we're seeing is more nuanced. There's a sense of this is ugly, but maybe temporary. Investors are still trying to decide whether this is a short-term shock or a longer-term regime shift.
That's the key, regime shift or temporary shock. How do you think about it from your Dondo lens?
I start with downside protection. In a high uncertainty environment, we ask, which businesses can survive if energy prices remain elevated longer than expected? I want a margin of safety in the business model, not necessarily in the market's mood. A company that can pass through costs, or one with net cash and low capital intensity, is inherently more resilient. That doesn't mean it wins, but it has a better chance of not losing much.
You're taking it back to heads I win, tails I don't lose much.
Exactly. And in a week like this, the tails matter. The headlines are loud, and we need to avoid knee-jerk reactions. For my framework, this isn't about predicting the next headline. It's about picking businesses that can withstand the unknown.
Let me push back on something. Some would argue the energy shock is exactly the kind of catalyst that flips a market regime. They'd say equities are too complacent.
That's a fair push. I'm not dismissing the risk. But there's also a pattern. Markets often overshoot fear in the first burst, then normalize when reality sets in. The question is whether this stays a supply shock that bleeds into every corner of the economy. I don't know yet. I need more data.
That uncertainty is useful. So, in practice, are you looking for anything specific or just monitoring?
Monitoring, but with a checklist. I'm watching for companies with real pricing power and low leverage. The danger is when you have high leverage and input costs spike. Those are the tails that hurt. I'm also looking at how customers respond. Do they trade down? Do they delay purchases? Do they stick? Those behaviors tell you whether this shock is truly feeding into demand destruction.
For listeners, it sounds like we're not just watching oil prices, we're watching how consumers and companies adjust.
Yes, that's the bridge from a headline story to a fundamental story. Headlines drive the initial move. Fundamentals determine the durability.
Let's widen the lens. There were stories about the Pentagon prepping ground operations and the Strait of Hormuz issues. We can't parse the geopolitics here, but market-wise, what mattered?
What mattered is the headline risk narrative. It feeds risk premiums. It pushes up insurance costs, shipping costs, and it creates a layer of uncertainty that businesses hate. But it doesn't immediately kill earnings. That's why markets can wobble but not necessarily collapse.
You keep coming back to earnings durability, even in a week dominated by geopolitics.
That's my gravity center. Earnings durability is where I look for protection. The headlines are the weather. The business model is the climate.
Great line. Let's transition to story 2 because this one touches the consumer directly. Deep dive number 2, the consumer squeeze. The takeaway this week put consumer sensitivity back on the front page, but the response may be uneven across income levels and sectors. The news talked about gasoline at $5. People feel that. But the market didn't assume a full consumer collapse.
Correct. When gas prices climb, the reaction isn't uniform. It's not the same for higher income households and lower income households. That matters for retail, travel, and discretionary names. In a Dondo framework, I want to avoid the double whammy. Businesses that face rising costs and weakening demand simultaneously.
You're saying, watch who gets squeezed from both sides.
Right. The market starts to price that in. But not all consumers pull back in the same way. Some trade down, some delay, some keep spending in areas they value. This is where company-specific resilience matters. If a brand has real loyalty and can offer value, it might hold up better than the headlines suggest.
So the takeaway is not consumer dies, but consumer shifts.
Yes, and that shift is what we want to capture. For example, businesses positioned for value might see more traffic, while premium discretionary names could face softness. But again, I'd avoid generalizations. There are premium brands that have pricing power and sticky customers.
Let's talk about the labor data, because it surprised people. Payrolls came in much stronger than expected, 178,000 versus 60,000. That's a big beat. How does that fit with the consumer squeeze narrative?
It tempers it. If employment is still growing, the consumer has some cushion. It doesn't erase the gasoline pressure, but it means the household balance sheet isn't collapsing. If wages are steady and jobs are available, spending patterns can shift rather than crash.
That's an important nuance. The knee-jerk fear is gas up, so spending dies. But if jobs are stable, the story is more about reallocation.
Exactly. It becomes a question of winners and losers, not a blanket collapse. That's why I emphasize downside protection at the company level. You can't just bet on the macro narrative. You need to find businesses that can adapt.
Let me probe your valuation lens here. Do you adjust your discount rates for this kind of headline risk?
I do, but carefully. The risk premium might rise temporarily when uncertainty spikes, but I'm cautious about overreacting. If you bump discount rates too aggressively for a short-term shock, you can end up ignoring businesses that are actually resilient. That's where a checklist helps. Focus on balance sheets, pricing power, and management quality, rather than just the headline volatility.
Management quality is your other anchor, right?
Always. In uncertain periods, you need leaders who have navigated shocks before. You want management teams that communicate clearly, allocate capital thoughtfully, and avoid excessive leverage. A strong management team can turn a tough environment into an opportunity, like picking up market share when weaker peers are under stress.
I hear you. But what about the argument that this is a different kind of shock, one with geopolitical unpredictability? Some would say management skill doesn't matter when the deck is stacked.
I'd push back on that. The deck is never fully stacked. There's always a range of outcomes. Management skill doesn't control the macro, but it controls how a company responds. That can make the difference between survival and prosperity.
That's clear. So with consumers under pressure, energy up, and geopolitical headlines everywhere, your lens says not all outcomes are the same. And the market reflected that.
Precisely. This was a week of dispersion, not a week of blanket fear.
Good. That brings us to rapid fire. We'll hit the remaining stories quickly, focusing on meaning, not noise. Rapid fire time, short and focused. First, futures dipped on weekend headlines as the war narrative dragged into a fifth week. What does that mean for investors?
It means volatility can return at any moment when headline risk is dominant. I'd treat it as a reminder to keep position sizes sensible and to avoid leverage. If you can't survive an overnight gap, you're taking too much risk.
Next, there was talk of a bounce in stocks as the war narrative eased. Some called it a bull trap, others saw opportunity. What's your take?
I avoid the bull trap language. That's too binary. In uncertain environments, there are legitimate rallies and pullbacks. What matters is whether the fundamentals back up the move. A short-term bounce isn't a signal by itself.
Another headline: global markets saw intense volatility. European benchmarks had a rough month, and U.S. indices flirted with correction territory. What does that signal?
It signals that uncertainty has gone global, but it doesn't mean every market faces the same outcome. Country-level differences in energy exposure, supply chains, and fiscal flexibility matter. It's another reminder to avoid overgeneralizing.
Oh, let's touch on tariffs. The administration announced 100% tariffs on certain branded pharmaceuticals and revised metals duties. How does that fit the narrative?
That's a policy overhang. Tariffs add friction, and friction raises costs. The market may not price it immediately, but companies exposed to those supply chains will have to respond. That's where management quality and pricing power again come into play.
There were also headlines about gasoline and diesel reaching records. We already mentioned $5 gas. How does that translate into market behavior?
It heightens sensitivity in consumer-facing names. You watch for pockets of demand softness and look for companies with flexible cost structures. The big idea is not the consumer is dead, but the consumer is allocating more carefully.
Last one, some commentators said stocks exploded as the war narrative cooled. Is that overstated?
I'd say so. The movement was meaningful but not euphoric. The market psychology is fragile right now. It swings on headlines, but it hasn't found a stable narrative.
Great, that's the rapid fire. Now, the predictions scorecard. This is where we hold ourselves accountable. Last week we said markets would focus more on the consumer response and less on pure headline shock. How did we do?
I think we were mostly right. The consumer squeeze narrative did surface, but it didn't translate into a total risk-off move. The market looked for signs of endurance.
We also suggested that energy strength would show up in leadership. That happened.
It did, but we probably underestimated how quickly sentiment could snap back on small hints of de-escalation. That's a miss.
Fair. I'll add one more. I expected broader fear across all sectors, and that didn't materialize. I was too pessimistic on breadth. So we keep score, we learn.
Exactly. The point isn't perfect prediction, it's improving the framework.
That leads to key lessons. Let's turn the week into lessons. Milan, give us 2, then I'll add 1 and the memory sentence.
Lesson 1. Headline risk doesn't always equal fundamental damage. Markets can digest scary headlines while still rotating into businesses that can handle the shock. Lesson 2. Focus on balance sheets and pricing power. In uncertain conditions, that's the closest thing to a safety net.
I'll add 1. Lesson 3. The labor backdrop matters more than a single cost shock. Strong employment can absorb a lot of pressure, and that changes the consumer narrative. And here's the memory sentence. If you take away one thing from this week, headlines screamed chaos, the tape whispered rotation.
That's a good one. It captures the cross currents.
It does. It also reminds us not to overreact. The market rarely moves on a single factor. It blends multiple stories at once.
That's right. And when it blends stories, it creates dispersion. Dispersion is where stock picking matters. That's where a Dondo approach can shine, because you're not trying to forecast every twist. You're trying to find resilience.
The biggest question I'm still wrestling with is duration. If energy stays elevated, does it eventually hit the macro in a bigger way? That's the unknown.
It is, which is why I'd stay humble and stick to the checklist.
Okay, let's turn to the watch list for next week. Next week's watch list, 3 observable items. Milan, you go first.
First, watch consumer spending indicators, especially travel demand and discretionary retailers' commentary. Not earnings, but signals from industry groups and company updates. Second, watch energy pricing trends. We don't need exact numbers. We need to know whether the spike is easing or staying sticky. Third, watch credit conditions. If borrowing costs tighten abruptly, that's a signal of stress filtering through.
I'll add my own framing. I'll be watching breadth, whether leadership broadens beyond energy and defensives, and I'll be watching corporate commentary for how they're managing costs. The way they talk about pricing tells you how much power they really have.
That's a good point. Management language can be more revealing than the headlines.
And a quick reminder for listeners, watch lists are about observation, not prediction.
Exactly. Think of it as staying aware, not trying to call the market.
Before we close, a final thought. This week asked investors to choose between panic and patience. The market didn't pick panic. It rotated, it adjusted, it searched for footing. That doesn't mean the risks are gone. It means the path forward is likely uneven, and that's normal.
I agree. The best response is to stay grounded in fundamentals and avoid decisions you'd regret when the headlines fade.
That's it for this week's Capital Sound Weekly Wrap. Thanks for listening. If you made it this far, take a breath, step back, and keep your framework. We'll be back next week with more clarity. Until then, stay curious and stay steady.